Welcome to all. If you work in finance, manage investments, lead a financial institution, or simply want to understand where the money world is heading, this video was made specifically for you. Today, we are exploring one of the most powerful and disruptive forces ever to enter the world of finance, artificial intelligence. The title of today's topic says it all: AI in finance and investing, reshaping markets, strategies, and risk management. And that word, reshaping, is chosen very deliberately, because what AI is doing to the financial world isn't a minor adjustment to existing systems. It is a fundamental reimagining of how markets function, how investment decisions are made, how risk is calculated, and how wealth is created and protected. This is a strategic exploration designed for three very specific audiences. First, institutional investors, the fund managers, asset allocators, pension funds, and sovereign wealth managers who move markets. Second, financial strategists, the analysts, advisors, and portfolio architects who build the frameworks that guide capital decisions. And third, technology leaders, the CTOs, data scientists, and fintech innovators who are actually building the AI systems that are transforming this industry. But here's the truth: even if you don't fit neatly into one of those three categories, what you're about to learn affects you. Because AI in finance doesn't just change Wall Street. It changes interest rates, loan approvals, fraud detection, insurance pricing, retirement planning, and the very structure of the global economy. So whether you manage billions or you're simply trying to manage your own financial future wisely, understanding AI's role in finance is no longer optional. It is essential. Let's begin. Before we dive into the deep end, let's make sure we're all speaking the same language. Because when people talk about AI in finance, they're not talking about one single technology. They're talking about a family of powerful tools, each with a distinct role, a distinct capability, and a distinct impact on how financial systems operate. This slide gives us our foundation. Let's walk through it together. The first technology is one you've almost certainly heard of: machine learning. At its core, machine learning is about pattern recognition from historical data for predictive modeling. Think about what that means in a financial context. Every trade ever executed, every market crash, every bull run, every interest rate cycle, every earnings report, every consumer behavior shift, going back decades. Machine learning takes all of that historical data and finds the hidden patterns within it, patterns that no human analyst could ever detect manually, and uses those patterns to predict what is likely to happen next. In finance, that translates directly into smarter trading algorithms, better credit risk models, more accurate price forecasting, and sharper investment decisions. The second technology takes things even further: deep learning. Deep learning uses neural networks, systems modeled loosely on the structure of the human brain, for complex market behavior analysis and portfolio optimization. Where machine learning finds patterns in structured data, deep learning can process unstructured complexity, the kind of multi-layered, interconnected market dynamics that defy simple rules. It can simultaneously analyze thousands of variables: currency movements, geopolitical signals, supply chain disruptions, sector rotations, and identify how they interact with each other in real time. The result? Portfolio optimization at a level of sophistication that was simply impossible just 5 years ago. Third, and this is one that has exploded into mainstream awareness: large language models, LLMs, the technology behind tools like ChatGPT, now being deployed with tremendous power inside financial institutions. In finance, LLMs are used for natural language processing, sentiment analysis, and research automation. What does that mean practically? An LLM can read every earnings call transcript, every analyst report, every news article, every regulatory filing, every social media signal related to a company or sector in seconds, and extract the sentiment, the tone, the hidden implications, and the forward-looking signals buried within. Research that used to take a team of analysts weeks now takes minutes. That is a competitive advantage of an extraordinary magnitude. And fourth, the most cutting-edge technology on this list: autonomous agents, self-directing systems for real-time trading and risk monitoring. This is where AI moves beyond being a tool that humans use into being a system that acts on its own within defined parameters. Autonomous agents can monitor markets in real time, 24 hours a day, 7 days a week, across every asset class simultaneously, identify risk exposures the moment they emerge, execute trades at microsecond speed, and adjust portfolio positions dynamically, all without waiting for a human to press a button. This is not science fiction. This is happening right now inside the world's most sophisticated financial institutions. Now, let's look at the two numbers on the right side of this slide, because they tell you everything about why this matters. $2.3 trillion. That is the size of the global AI market specifically from finance alone. Not the entire AI market, not the entire fintech market, the AI market from finance. That number alone tells you that this is not an emerging experiment. This is the foundation of modern financial infrastructure. And then 85%. 85% of enterprises are already using AI tools. That means if your organization is not actively deploying AI in its financial operations, you are already in the minority. You are already behind. So that is our foundation. 4 technologies, 2 staggering numbers, and 1 undeniable reality. AI is not arriving in finance. It has already arrived. Now let's explore exactly what it's doing and what it means for every stakeholder in the financial ecosystem. Now that we understand the foundational technologies powering AI in finance, let's look at where those technologies are actually being deployed. This slide reveals the 6 core applications that are actively transforming the financial industry right now. These aren't theoretical use cases. These are live operational systems running inside banks, hedge funds, insurance companies, and investment firms around the world. Today, let's go through each one. Application number 1, algorithmic trading. High-frequency execution with microsecond decision-making. Let's pause on that phrase for a moment. Microsecond decision-making. A microsecond is 1/1,000,000th of a second. In the time it takes you to blink, which is roughly 150 milliseconds, an algorithmic trading system can execute 150,000 individual trading decisions. It is scanning price movements, order book depth, volatility signals, and market liquidity simultaneously across multiple exchanges and asset classes, and acting on that information at a speed that no human trader can remotely compete with. Algorithmic trading now accounts for an estimated 60 to 75% of all trading volume in major markets. This isn't the future of trading, it is trading. Application number 2, quantitative modeling. Multi-factor models for risk-adjusted returns. Quantitative modeling, or quant modeling as it's known in the industry, uses AI to build sophisticated mathematical models that evaluate investments across dozens, sometimes hundreds, of variables simultaneously. Interest rate environments, volatility regimes, sector correlations, macroeconomic indicators, company fundamentals, technical signals. All of these factors are weighted, tested, and optimized to identify investment opportunities that offer the best possible return for a given level of risk. The key phrase here is risk-adjusted returns. It's not just about making money. It's about making the right amount of money relative to the risk being taken. And AI-powered quant models do this with a precision that manual analysis simply cannot match. Application number 3, robo-advisory. Automated portfolio construction and rebalancing at scale. This is the application that has perhaps the most direct impact on everyday investors, not just institutions. Robo-advisors are AI-powered platforms that automatically build and manage personalized investment portfolios based on an individual's financial goals, risk tolerance, time horizon, and tax situation. And they do this at scale, meaning the same system can manage portfolios for 1 million clients simultaneously with the same level of personalization and care that a human financial advisor might give to just one. The cost? A fraction of traditional advisory fees. The accessibility? Anyone with a smartphone can access institutional quality portfolio management. Robo-advisory is democratizing wealth management, and AI is what makes it possible. Application number 4, credit and fraud detection. Real-time identification of default risk and anomalies. This application works silently, in the background, protecting the integrity of the entire financial system. On the credit side, AI models analyze thousands of data points to assess whether a borrower is likely to repay a loan, going far beyond the traditional credit score to include behavioral patterns, spending habits, employment stability, and even alternative data sources. The result? Better lending decisions, lower default rates, and importantly, fairer access to credit for people who might be underserved by traditional scoring models. On the fraud side, AI monitors every transaction in real time, comparing it against established patterns of normal behavior. The moment something anomalous appears in an unusual location, an atypical amount, a suspicious sequence of transactions, the system flags it or blocks it instantly. Every time your bank sends you a fraud alert, that is AI working exactly as designed. Application number 5, portfolio optimization, dynamic asset allocation within risk constraints. Portfolio optimization takes the principles of quantitative modeling and applies them continuously in real time to an active live portfolio. As market conditions change, as volatility spikes, as correlations shift, as new information enters the market, AI systems dynamically rebalance portfolio allocations to keep them aligned with target risk levels and return objectives. The word dynamic is critical here. Traditional portfolio management was largely static. You built a portfolio, you reviewed it quarterly, you rebalanced it annually. AI-driven portfolio optimization is continuous. It never sleeps, it never misses a signal, and it never lets emotion override the data. Application number 6, risk analytics, predictive VAR, stress testing, and systemic risk modeling. This is perhaps the most important application of all because it is the one that protects the entire financial system from collapse. VAR, value at risk, is the industry's primary measure of how much a portfolio could lose under adverse conditions. AI-powered predictive VAR models can calculate this with far greater accuracy and speed than traditional methods. Stress testing takes this further, simulating extreme scenarios like the 2008 financial crisis, a pandemic-triggered market collapse, a sovereign debt default, and measuring exactly how a portfolio or institution would perform under those conditions. And systemic risk modeling looks at the big picture, mapping the interconnections between institutions, markets, and geographies to identify where a shock in one area could cascade into a broader financial crisis. In short, risk analytics is what stands between intelligent financial management and catastrophic failure. Now, look at the insight at the bottom of this slide. It says, the integration of these applications creates synergistic competitive advantages through data sharing and model refinement. This is a crucial point. These 6 applications don't just work in isolation, they feed each other. The fraud detection system improves the credit model. The trading algorithm informs the portfolio optimizer. The risk analytics engine sharpens the quantitative models. Together, as an integrated AI ecosystem, they create a competitive advantage that is compounding. The more data the system processes, the smarter it becomes. The smarter it becomes, the better every individual application performs. This is why institutions that invest in AI infrastructure today are building a moat that will be almost impossible for laggards to cross tomorrow. 6 applications, deeply interconnected, continuously learning. This is what modern AI-powered finance actually looks like. Now we get to the section that every investor, every fund manager, and every financial strategist in the room needs to pay very close attention to, because this slide answers the question that matters most. What does AI actually mean for markets, and where is the money? Let's break it down into 2 parts. First, how AI is changing market dynamics, and second, where the real opportunities lie for investors who are paying attention. Let's start with market dynamics, the ways AI is fundamentally altering how financial markets behave. First, liquidity through continuous market participation. AI-powered trading systems never sleep. They participate in markets 24 hours a day, across every time zone, on every major exchange. The result is deeper, more continuous liquidity, meaning there are always buyers and sellers available, prices are more stable, and large orders can be executed with less market impact than ever before. For institutional investors, this is enormously valuable. The ability to move large positions without dramatically moving the market is a capability that AI has fundamentally enhanced. Second, price discovery via information processing. Markets are, at their core, information processing machines. The faster and more accurately a market can process new information and reflect it in prices, the more efficient that market becomes. AI processes information at a speed and scale that is orders of magnitude beyond human capability. News events, earnings releases, economic data, satellite imagery, social media sentiment, all of it absorbed, interpreted, and acted upon in milliseconds. The implication? Markets are becoming more efficient faster than ever before, which means the window for exploiting informational advantages is narrowing unless you have AI working for you. Third, bid-ask spreads from competition and automation. The bid-ask spread, the difference between what a buyer pays and what a seller receives, has been dramatically compressed by AI-driven competition among market makers. For retail investors and institutions alike, this means lower transaction costs. Every trade is slightly cheaper, at scale, across millions of transactions. That adds up to billions of dollars in savings flowing back to investors. Fourth, volatility spikes from correlated AI trading. Now, and this is critically important, not all of the market dynamics driven by AI are positive. When thousands of AI trading systems are trained on similar data and optimized for similar objectives, they can make similar decisions simultaneously. And when they all move in the same direction at the same time, volatility can spike sharply and unexpectedly. This is one of the genuine systemic risks that regulators around the world are actively monitoring. AI-driven markets can be more efficient on average, but more fragile in moments of stress. And fifth, behavioral shifts in retail investor participation. AI has changed how retail investors, everyday people, engage with markets. Robo-advisors, AI-powered trading apps, algorithmic investment platforms, these tools have brought millions of new participants into financial markets who previously had neither the knowledge nor the access. This democratization of participation is reshaping market microstructure in ways that are still being understood. Now, let's turn to the right side of this slide, because this is where it gets genuinely exciting. Investor opportunities. 4 areas where AI creates real alpha. Opportunity number 1, alpha generation from alternative data sources. Alpha, in investment terms, means returns that exceed the market benchmark. It is the holy grail of active investing. AI is generating alpha by processing alternative data, sources of information that go far beyond traditional financial statements. Satellite imagery tracking retail parking lot traffic to predict sales before earnings. Credit card transaction data revealing consumer spending trends in real time. Natural language processing of patent filings to identify technological breakthroughs before they hit the news. This is the new edge, and it belongs almost exclusively to those with AI capability. Opportunity number 2, operational efficiency reducing cost to trade. For institutions managing large portfolios, the cost of executing, monitoring, and managing trades is substantial. AI is slashing those costs through automation of back-office processes, intelligent order routing, reduced error rates, and optimized execution timing. Lower costs mean higher net returns. For a fund managing $10 billion, even a fraction of a % improvement in operational efficiency translates into tens of millions of dollars in additional value. Opportunity number 3, personalized wealth management at scale. We touched on this with robo-advisory, but the opportunity here extends far beyond automated portfolio construction. AI now enables truly personalized financial planning, tax optimization, estate planning, retirement modeling, insurance allocation, all tailored to an individual's complete financial picture, updated in real time, and available at a cost accessible to the mass market. The wealth management industry is being democratized, and the firms that build AI-powered personalization at scale will capture an enormous share of a market that was previously accessible only to the ultra-wealthy. Opportunity number 4, new investment products, AI funds and quant strategies. Perhaps the most direct opportunity of all, the emergence of entirely new categories of investment products built specifically around AI capability. AI-driven hedge funds, quantitative ETFs, machine learning-powered factor strategies, alternative data funds. These products are attracting significant capital flows because the track records are beginning to speak for themselves. AI-driven strategies are demonstrating consistent risk-adjusted outperformance in a growing number of market environments. And now, the most important box on this entire slide, the competitive edge insight at the bottom. Firms using AI-driven strategies are reporting 15 to 25% lower operating costs, 2 to 4% annual alpha premium, 50% faster portfolio rebalancing. Read those numbers again. 5 powerful trends are reshaping finance right now. AI-driven sentiment analysis is scanning millions of news and social media signals in real time. Generative AI is automating financial research that once took entire analyst teams. Blockchain and AI are converging for autonomous settlement. Tokenized assets with smart contracts are creating entirely new investment structures. And self-optimizing funds are making investment decisions, completely autonomously. But don't just take our word for it. The proof is in the results. Renaissance Technologies uses quant models generating 30% plus annual returns. BlackRock's Aladdin platform serves over 200 institutional clients globally. Citadel's AI-driven trading captures market microstructure advantages at scale. And Wealthfront's robo-advisory platform now manages over $30 billion in assets. The trends are real. The adoption is real. The results speak for themselves. This is AI in finance, but not theory, reality. With great power comes serious responsibility, and AI in finance carries 5 critical risks that cannot be ignored. Model bias from training data skews investment decisions unfairly. Data quality and outlier events can cause catastrophic miscalculations. Black box opacity makes it nearly impossible to explain why AI made a decision. Correlated AI trading creates dangerous systemic risk across markets. And cybersecurity threats, including model poisoning attacks, can silently corrupt entire systems. Regulators worldwide are responding. The European Union's AI Act establishes high-risk classifications. The US SEC has issued guidance on model risk management. The UK's FCA governs algorithmic trading directly. And across Asia-Pacific, emerging fintech sandboxes are shaping new frameworks. The mitigation strategy, explainability frameworks, continuous monitoring, model retraining protocols, and rigorous third-party audits. The message is clear. AI in finance must be powerful and responsible. Both, always. Let's talk about what this all means strategically, because this slide contains perhaps the most important statement in this entire presentation. The investment thesis reads, AI is not a cyclical trend. It represents a fundamental restructuring of financial intermediation, market microstructure, and asset valuation. Winners will consolidate around scale, data, compute, and talent. Remember those 4 words? Scale, data, compute, and talent. They define who wins and who doesn't. Now let's look at the timeline. In the next 2 years, robo-advisory becomes mainstream, regulatory clarity finally emerges, and traditional firms begin serious AI infrastructure investment. Over the next 2 to 5 years, autonomous fund managers become a reality. AI-driven price discovery dominates markets, and entirely new risk categories emerge that we don't yet have names for. Beyond 5 years, decentralized AI systems on blockchain reshape settlement infrastructure, AGI begins impacting institutional decision-making, and the entire architecture of the financial system gets reimagined from the ground up. The direction is clear. The question isn't whether AI will transform finance. It already is. The only question is whether you'll lead or follow. And so, we arrive at our final slide, the 5 truths that every person watching this video needs to carry with them. Takeaway number 1, AI transforms financial markets across trading, risk, and advisory, creating asymmetric competitive advantages. Asymmetric, that word matters. The gap between AI-enabled firms and those without it isn't linear. It compounds. Every quarter widens the divide. Takeaway number 2, institutional investors must invest in AI infrastructure, talent, and data governance to remain competitive, not to get ahead, to simply remain relevant. This is now the minimum standard of serious institutional participation. Takeaway number 3, regulatory clarity is arriving. Early adopters will shape compliance standards and gain first-mover advantages. The firms helping write the rules today will operate most comfortably under those rules tomorrow. That is an enormous strategic advantage. Takeaway number 4, risks are manageable through explainability, monitoring, and governance, not through abstinence. Avoiding AI because of its risks is itself the greatest risk. The answer is responsible adoption, not avoidance. And takeaway number 5, the next decade belongs to firms that integrate AI systematically across their operations. Not partially, not experimentally, systematically. Your next steps are clear. Assess your AI readiness, invest in governance frameworks, and explore strategic partnerships. The future of finance is intelligent. The only question is, are you? We stand at the most consequential inflection point in the history of finance. Artificial intelligence isn't approaching. It has arrived. It is trading, analyzing, advising, and managing risk right now. At a scale and speed no human institution can match alone. The firms that embrace it thoughtfully will define the next era of financial leadership. Those that hesitate will watch that era pass them by. The technology is ready, the data is available, the opportunity is now. The only remaining question is your decision. Choose wisely. Thank you for watching.